Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Now, today I want to talk about tax minimization, and I want to put out there that it's erroneous and just not the right approach to be too focused on tax, that there's a variety of considerations that investors need to optimize, and quite often more important considerations than taxation to do so. And that's what I want to talk about today. And the reason I want to talk about it is because I think, especially after next week's federal budget, I think we'll be talking about taxation a lot. And I think it will be natural when there's changes in taxation for people to become fixated on what to do, how to minimize, all those sorts of things. And I just think we want to take a really balanced approach with respect to these changes. Taxation changes aren't unusual. Tax is always changing, really. And as investors, it's only one of the things that we kind of need to navigate. Now, just for a bit of fun, I thought we might throw to the late Kerry Packer. He was Australia's richest man in 1991 when he appeared before House of Reps Select Committee. And let's take his advice on tax minimisation.
Now, of course, I am minimising my tax, and if anybody in this country doesn't minimise their tax, they want their heads ripped. Because as a government, I can tell you're not spending it that well that we should be donating extra.
Now, I don't think that clip ever gets old. He's bang on. He was bang on in 91. And if that was the case in 91, it's probably even more of a concern today in terms of how the government's spending money. And I think we're going to see that reflected in the budget, of course, in terms of there's going to be some cuts, there's going to be some higher taxation. So, of course, we all know about loss aversion and how it applies to finances and losing money and so forth, in that we feel losses twice as hard or twice as difficult as gains. So, of course, we want to minimise tax. We don't want to donate any extra, as the late Kerry Packer says, and would be stupid not to really think carefully about all tax minimisation. So I'm not talking about that, but I really want to frame it to say, look, tax is one of many considerations, as I said at the beginning. And an over-focus on taxation can come at a much greater cost because you're ignoring what might be even more important to optimize. Now, anyone that's listened to this podcast for any length of time knows I love to delve into the numbers and I like an evidence-based approach. So let's start there. Let's start at the numbers, because I did some financial modeling, and my goal with the financial modeling was to try and assess to what extent can tax change after tax returns. So to what extent do I need to really worry about tax is another way to sort of put it. So what I did is I modeled both investing in shares and property. So for property, I bought a property today, sold it in 30 years' time, repaid the loan, paid all capital gains tax. Obviously enjoyed some negative gearing along the way. For shares, I took a slightly different approach. So we're not put out here, we're not comparing apples with apples here. So with shares, I took an ungeared approach, invest $5,000 a month for the next 30 years, and then sell the whole share portfolio in one hit. Now that's, of course, unlikely. One of the benefits of investing in shares is that we can sell incrementally. We can sell one share rather than the whole portfolio, and probably do that unless we really needed the money all in one hit. But again, what I want to do is assess the impact of capital gains tax and income taxes and what sort of drag do they create on investments. So of course, I've got to assume that we sell in all one hit just to make it at least comparable to some degree with the property case study. So what I found was a little bit surprising. What didn't surprise me on the property side was that capital gains tax really doesn't have that big a drag. I mean, again, it's still material and we should think about ways that we can minimize it, but there's only so much we can do. So once we've done that, we should just move on. And really the difference between, say, the old indexation system and the current 50% CGT discount system, if we just change that and we looked at the internal rate of return, the internal rate of return was lower with the old indexation system by 0.8 of 1%. So we're really comparing an internal rate of return of 10% versus 9.2%. So it's material, but it's a less than a 10% differential. So it's not really going to move the dial to the extent that, investing in property becomes no longer attractive. And in fact, if you removed all taxation consequences from investing in property, the internal rate of return drops to 8.9%. So 1.1% total drop. Now, the reason why it drops is because if we take out capital gains tax, we also then have to take out negative gearing. And negative gearing is very valuable to us because obviously saving $1 worth of tax today is way more valuable than a small saving in capital gains tax. But I think what it tells us is that with the negative gearing together with the CGT, the tax drag on property isn't that substantial and is probably less substantial than we might initially think. And the reason taxation has a smaller impact in property investing is twofold. Firstly, the gearing. The gearing is really responsible for driving almost half of the internal rate of return result. So property without gearing is going to give you substantially less return because it requires more capital up front. So if you're not going to borrow to invest in property, then you've got to find the $1 million or $2 million or $500,000, whatever that property is going to cost. You need to find that in cash. And obviously that's capital heavy. And so that reduces your internal rate of return substantially. So the benefit that we get from gearing means that the taxation component of the return, whether that's positive or negative, positive from a negative gearing perspective and negative from a capital gains tax perspective. So whether that's positive or negative, the proportional impact of taxation with property is lower because of gearing. And then secondly, the underlying performance of the asset. So if we're buying an investment grade asset and we're getting compounding capital growth, then that with the impact of gearing means that the impact of taxation and its impact on total returns is going to be proportionately lower. And that's why for property investors, the taxation drag isn't such a big deal. Really, the energy, if you're going to worry about anything, don't worry about capital gains tax, worry about maximizing negative gearing benefits. Make sure you do that first and foremost, and then think about capital gains tax. I mean, hopefully you can optimize both, but they tend to be really point in time decisions rather than ongoing decisions. Now, for a share portfolio, the taxation drag was a lot higher. And what I've done is, as I said, I assume we invest $5,000 a month for the next 30 years, then sell the entire portfolio. Again, that assumption is not really realistic. And I've assumed that the portfolio only throws off about 2% of income or realized returns. So most of it's coming in capital growth. And I think we can structure a portfolio to do that. I know we can, looking at historic evidence. So I think that's realistic as well, which means the taxation drag as we hold that portfolio, because it's generating relatively low income, the taxation drag isn't that big a deal. All the taxation drag is really in the capital gains tax. And the reason why we're paying so much capital gains tax is because we're selling the full portfolio in one hit. The next consideration is I don't have any gearing in the share portfolio. If I had gearing in the share portfolio on an internal rate of return basis, it's probably going to look a little bit better. And again, I'm comparing property and shares. This is not a property versus shares debate. This is really just trying to analyze, using the most realistic scenarios, what is the taxation drag. So let me put some numbers around it. If we took taxation from the share portfolio out of the consideration, so no tax, the pre-tax internal rate of return, 9.3%, pretty good. If we look at the 50% discount, CGT discount, the internal rate of return drops to 7.8. If we look at the old indexation system, it drops to 7.2. So in terms of impact of changes in capital gains tax at the most extreme levels, so selling the share portfolio in one hit, the tax drag isn't that much different to property. And so it's not that big a deal. I would argue because we can sell share portfolios incrementally, we can aggressively manage, I think, that capital gains tax drag. And so I think what this analysis does, these numbers really help us understand that yes, taxation is important to minimize. Yes, loss aversion means that if we're paying out expenses or bills, we feel that twice as hard as getting a gain. So psychologically, it feels painful, but the reality is that taxation isn't really contributing that much to our after-tax returns. So then what I want to do is talk about what does this all mean for you and what are the important decisions? Where should your focus go? And hopefully this framework will help you sort of navigate the next couple of weeks of information, particularly that are obviously coming out of the budget. So the first one is ownership structure. Ownership structure obviously is going to dictate the amount of the taxation outcomes. So both from a properties perspective, the negative gearing benefits, which are very valuable, more valuable than the CGT, and ultimately the amount of capital gains tax that is paid. And our general approach at Pro Solution is to put greater weight on annual taxation rather than capital gains tax. So really the two things to think about with respect to property is negative gearing benefits, as I've stated many, many times, and land tax. They're the two things that we think quite carefully about, and we want to be in a position where we're able to maximize them, and we want to have an ownership structure and a funding structure that gives us flexibility to still maximize these taxation benefits, even if there's a change in personal circumstances. Now, you can't do that perfectly well in every scenario, but you can certainly give some consideration to it and build that into the plan. Now, sometimes it's not possible. Let me share an example of a client that we're working on. We haven't arrived at a conclusion yet, but it was a really interesting and timely sort of case study to share with you. We have a client I won't actually mention where they are just to preserve privacy, but we've got a client that purchased a property that they were planning to Airbnb. And it was a coastal property, and they thought, we will use it some of the time. We'll probably use it more often later in life, maybe 10 years down the track. But over the next 10 years, we're going to buy this property, we're going to Airbnb it, and we'll occupy it some of the time. When it's not booked out, we'll go and maybe use it. And as a result, we did some projections, cash flow projections. We worked out that the property was most likely going to be positive cash flow. And so we put the property 99% in the spouse's name. The spouse had a much lower taxable income, and we thought that was going to minimize the tax drag on that property. Now, fast forward, I don't know, maybe 3 or 4 years, the clients changed their mind. It was a pain in the neck to Airbnb. It was too challenging. The cash flow wasn't as good as they expected it to be. And now they're considering putting a permanent tenant in that property. But of course, that's going to change the income profile and also the taxation position as well. And so we think we can transfer that asset from the spouse's name into the higher income earner's name. And that's going to crystallize stamp duty, unfortunately. We're probably not going to pay too much in the way of capital gains tax, hopefully. So it's really just the stamp duty cost. But when you look at the negative gearing benefit, the payback period is less than 2 years. So if this client's going to hold the property for another 10, then they're going to be wildly better off by making that transfer. Now, it's a big pill to swallow. It's a big transactional cost to get your head around. And we haven't got our head around it yet. We haven't finalized the advice. But what it does do is shows you how valuable negative gearing benefits are from a internal rate of return perspective. And that's an important measure because really that's what we want. We want our money to work hard for us, and the internal rate of return is telling us how hard our capital is working. So that's why when we think about these things and we put a strategy together, we do put a lot more weight on negative gearing benefits and also then land tax consequences. With respect to shares, I think I've shared this before in the podcast. My reflection over the last 20 to 25 years is I've regretted not establishing a family trust to hold a share portfolio for clients more than I've regretted establishing one. In fact, I can't remember a single instance where I wish I hadn't set a family trust up, but there's been plenty of situations where, in hindsight, I look back and go, well, it would have been nice to have these shares in a family trust. Now, it's possible when you've got a market correction or different circumstances occur that you can eventually transfer them into a family trust. So you might be able to sort of manipulate that down the track. But I like simplicity. I like to avoid unnecessary cost, but pursuing simplicity at the expense of future flexibility can also still be a costly mistake also. So my inclination, depending on the size of the portfolio and the amount that we're investing, of course, is to lean towards using a family trust to hold share investments. And that's going to do two things. Firstly, it's going to help us manage the ongoing taxation consequences. Now, when the share portfolio is relatively small, those taxation consequences such as dividends and any realized capital gains aren't that material. But as the share portfolio increases, it becomes more material. The problem with that then is hopefully you're also sitting on a lot of unrealized capital gains. gains. So there's nothing you can do about it at that stage when it starts to become material. And that's why I say, in hindsight, I wish we had have used a family trust more often with client scenarios, because it's later, after investing in shares for 10 or more years, that's when the taxation consequences start to mount up. Also, if we want to navigate and minimize capital gains tax consequences of selling down a share portfolio, a family trust is certainly going to help us do that. And certainly in situations where we have clients that want to help their children financially down the track, either get into the property market or early inheritance, these sorts of things, a family trust can be a really great vehicle to do that, because you can distribute the gain. That's part of your gift. Your gift is here's a realized capital gains tax outcome. But, if it's in your child's name, potentially the taxation consequence, or hopefully the taxation consequences, are much lower. So thinking very carefully about ownership structure, and that tends to be a point in time decision, but you've got to really think carefully about what's going to work now, what could change in the future, and what changes in the future have we seen given similar client circumstances, which I think is a lens that, an advisor can bring, because we've seen many people in many circumstances. So we kind of know, we don't know what's going to happen in the future, but it rhymes. There's some common themes. And then also still, when there is a major change in circumstances or major change in the asset's use, then we need to revisit that ownership structure consideration and then weigh up, whether we need to make some changes. But these aren't ongoing things. These are really, let's think about them, let's make a decision, let's then move on. Let's not ignore it, but we don't need to keep putting energy towards these sorts of decisions. Now, ownership structure is going to dictate current and future taxation liabilities or benefits. Funding structure, so that is, do we borrow to invest or not borrow to invest, is your next most important decision. It's important to really get right, of course. I've done that analysis a few years ago, back in 2023, in fact, and the link is in the blog on the website to this previous 23 blog. And what I did is I pulled apart the impact of gearing. And in an internal rate of return of, say, 14%, 6.5% was delivered by gearing, which sort of suggests that 60 or more percent of your total return of investing in property is because you've geared it, because you've borrowed to invest, rather than the property itself. And that's why we tend to look at a property versus shares decision as a really gearing versus non-gearing decision, although of course you can gear with shares as well, but tend not to do it as heavily or as aggressively. And if we're going to have gearing within a portfolio, we tend to push it more in the property side, in asset class, rather than the share side. But it's really important not to conflate the two distinct decisions, how to fund an investment and the investment itself, right? And it's really, really important, I think, for us to distinguish between what is property and what's the attraction to property as an asset class, and then how are we going to fund that investment. So whether we use capital or whether we use borrowed funds to do that. And quite often, as I said, a lot of people go, oh, property's so great. Well, yes, it is. There's certainly some positive characteristics with property, but gearing can explain many of them. And how you fund an investment is your decision as the investor. It has nothing to do with the asset class. And it's just really important not to conflate those two things, because they're two separate decisions. Now, gearing is an important decision because it can help you achieve better financial outcomes or lower risk. So I think investors can misuse gearing in two ways. Firstly, they can be too aggressive. And I've seen over the last 25 years, I've seen some investors looking at their tax returns, years where they've had no taxable income because they've geared so heavily that their negative gearing benefits, their losses from the investment, offset all other taxable income. Doesn't make a lot of sense, because if your taxable income falls below $45,000, you're really not paying a very high rate of tax. So you're not getting a very good negative gearing benefit, and it starts to become uneconomical. Plus also, borrowing to that extent starts to become more risky. So I think if you have no borrowings, that could be arguably seen as lower risk, but also it's not as efficient as you could possibly get because you're funding all your investments through your own capital. If you get maybe 50% gearing, depending on your age and stage and circumstances, you might argue that that's relatively efficient because you're using other people's capital, the bank, to build your asset base. You're getting some negative gearing benefits. benefits, so you're defraying the holding costs of carrying that debt over time, but you're not to the point where you're geared so heavily that it becomes risky. But if you geared at 100%, for example, you start to move the risk-return equation too far in the wrong direction, where you're taking on way too much risk, and you're probably never going to earn a return to be compensated, a high enough return to be compensated for that risk. So it's really important to understand where the right level of borrowings exist. Similarly, we've seen situations. We came across a client in the last few weeks that they've amassed a substantial amount of wealth, tens of millions of dollars, and they've got no gearing at all. They've got all their cash sitting in offset account. Now, that might be okay. I mean, you might take the view that we're quite comfortable and that's more of a personal preference rather than, financial advice, and that's fine. So I acknowledge that. Financial advice doesn't trump personal preferences, but I would look at that in isolation of any client preferences and go, that's relatively inefficient. We should introduce some level of gearing to that portfolio because that's going to help, leverage more of the return. And ultimately, if we do it safely and well, which of course we would, ultimately that's going to achieve better outcomes for that client. So gearing as a decision is really important. And I think it's one that we need to revisit regularly, at least annually, I think. Do we have enough gearing in our financial structure and our portfolios? Would we benefit from more or less gearing? Where should our focus be? These sorts of decisions become far more impactful, or potentially far more impactful, than really obsessing about, taxation deductions at the margin. Now, beyond ownership structure and gearing, the single most important driver of long-term after-tax returns is the underlying performance of your investments. And I would say that's where 80% or more of your energy should be focused rather than, taxation, which we've already established really doesn't, is really at the margin. So in last week's blog, I talked about property and the compliance and legislative policy risk associated with property, and that I believe, actually something I didn't mention last week is you've got to overlay borrowing capacity on top of that. So you've got to acknowledge that in the last 20 years, borrowing capacity has declined. In the previous 20 years, it expanded. So an expansion of borrowing capacity in the 80s, 90s and 2000s certainly contributed to property price growth. So that was a very strong tailwind. As well as then we've got more policy risk, as I discussed last week. So I think a passive buy and hold approach with property is no longer appropriate. You don't need to be massively active and be flipping properties. So I'm not suggesting that, but we can't be passive about it. And also a few weeks ago, episode 405, I talked about constructing an ETF portfolio and adopting a value-aware asset allocation. And essentially what I wanted to impart in that episode is that if you have the knowledge and skill and experience to construct an ETF portfolio that both reduces the underlying portfolio's risk, but also exposes the portfolio to potentially higher medium-term returns, that is a good way in order to, execute a very successful investment strategy. And there's going to be some people that are very comfortable and able to do that themselves. Some people are going to need advice to do that, but it's really just acknowledging that it's a different approach than just very, very passive market cap indexation investing. The point I'm trying to get across is focus on what you can control. What you cannot control is how markets behave. What you cannot control is what the Victorian government introduces with respect to tenancy laws, or New South Wales or Queensland. They're all going to harmonise. It's all going to end up in the same place or broadly in the same place anyway. But we can't control those things. You can't control what Trump might do or what is included in the federal budget next week. What you can control is how you invest and where you invest, which is what I try and talk about mostly in this podcast, and what I've certainly spoken about over the last couple of months, just giving you some tips in terms of how to use those two major asset classes in order to achieve better outcomes. And that's really the theme that I want to try and get across today, is that you've got to really worry about things that you can control. Use an evidence-based approach and don't let your emotions get ahead of you in terms of when there's changes to taxation rules, you overreact and overemphasize the importance that these changes might have on your success. Now, that's not to say ignore them. It's not to say ignore tenancy laws. It's not to say ignore these risks. We still have to be conscious, but what I'm saying that there's more important elements to really focus on. So if I was then to summarize this as a sort of hierarchy or a framework for you to sort of understand, in what order would I attack these problems, or do I attack these problems? The first one is asset selection and ongoing management. So asset selection in terms of which property do I buy, which ETF funds do I utilize? And then ongoing management really talks about, or talks to, how do I improve the income profile? How do I improve the capital growth prospects of the property? Where am I investing new cash into my ETF portfolio so that I'm able to sort of rebalance or expose the portfolio to sectors of the market that represent better future returns? So that's by far the most important. That's where most of your energy should be focused. Second is funding structure, which is really how much gearing, and it's really considering how much gearing is too much and how much gearing is too little as well. Now, this can be personal preferences, particularly as we get closer to or into retirement. But depending on your asset base size, if it's substantial, probably some level of gearing to maintain deep into retirement might be efficient to do so. Third is ownership structure. So typically we only need to consider this once, which is not to say we need to ignore it and not revisit the decision, as the case study that I sort of shared earlier in today's episode. But certainly the beginning, we want to make sure we make a really well-informed decision about ownership structure when we buy the investment, because we hope to buy, never sell, and kick the can in terms of the taxation consequences down the road. But we need to also think about, what ownership structure is going to accommodate me today, but what might change in the future, and how will that ownership structure accommodate those changes in the future? But also, as I said, it's not bad to revisit that decision every so often, particularly if your circumstances change substantially or if the asset changes. And then finally, tax planning within those structures is the fourth and final element to really optimizing after-tax returns. So that could be things like timing of disposals or divestments, distribution strategies, utilization of any capital losses that might be existing in any entities, and those sorts of levers that we can pull on a sort of annual tax planning basis. But I think the important observation is by the time you reach item 4, tax planning, much of the outcome is already determined. Tax planning on a poorly selected, ungeared asset that's held in a suboptimal structure is optimizing really the least important variable last. Of course, the maths is pretty clear. If I earn 8% per annum over 30 years, my assets grown from 1 million to 10 million. If I earn 5% over that 30-year period, my assets $4.3 million. I'd much prefer to pay more tax owning the $10 million property, as long as it's not $6 million more tax. Of course it won't be, but it's quite obvious that gross returns, maximizing gross returns, there's no real tax saving measures that are ever going to close that gap between, say, $4 and $10 million, of course. Now, this is not an argument for ignoring tax. I mean, that's a big part of our business is tax advice, business advice, tax preparation, all those sorts of things. But it's an argument for taking a proportional approach. It's an argument for taking a proportional approach, particularly over the next couple of weeks when we'll be bombarded with a lot of taxation changes. The goal hasn't really changed. It's build a portfolio of quality assets, fund it intelligently, hold them in the right structures, and proactively manage those assets. Tax is one input into that system, an important one, but not the only one that should drive those sorts of considerations. Okay, I will leave it there for this week. Next week, Wednesday's episode will be all about the federal budget, which I'll record on Tuesday night. So I look forward to sharing you with that. Let's hope there's not too much bad news in that, but until then, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.